Hot on the heels of a week that's been dominated by US inflation, with the core metric remaining elevated, we see the same kind of questions emerge this week, in a week that sees CPI readings coming out of the UK, Canada, and Japan, alongside some PMI figures also on Friday. So let's look ahead to the week ahead for the week starting Monday, the 18th of November. So here are the big ticket items according to Trading Economics. You can see on Tuesday, really things get going with RBA minutes out of Australia, the inflation metric expected to rise in Canada up to 1.9%. Trade data from Japan. Then on Wednesday, we see inflation data once again, this time from the UK, with once again a rise expected up to 2%. And Thursday, we see CPI from Japan, 2.5%. But will we see inflation ease significantly in Japan to take some of the pressure off the calls for further tightening from the BOJ? And like I said, Friday, we do see, although we've only got one of them mentioned here, we see a whole raft of PMI figures coming out across the globe. So let's kick off first and foremost with a focus on the UK. We don't necessarily have all of the predicted metrics filled in here according to when I grabbed the data, but worthwhile checking different economic calendars because it's going to be different depending on where you're looking. I generally will utilize lots of Trading Economics for more detailed breakdown than Forex Factory for a sort of top level breakdown. But what's notable here is, of course, headline inflation 1.7 last time around, 3.2 on the core metric. So that major differential, which is almost double core, is on the headline number. We need to see a shift in that narrative. We need to see core inflation moving towards the downside if we're going to grow more confident in the ability of the Bank of England to cut rates going forward. And certainly, much like the FOMC, markets are easing back in terms of their expectations on the easing front. When it comes to the PMI numbers, we've also got them accompanied by retail sales on Friday. The expectation for the PMI numbers is that we're going to see improvement, in particular on the services number up to 53, that helping the composite number up to 52. In terms of some of the different elements to be looking out for, here's a breakdown in terms of the headline CPI for the UK. And what's notable this time around is that whilst last month, the September metric came in essentially flat, we're also seeing the October from last year figure of 0% being stripped out. And that's why it's very difficult for us to see any disinflation this time around, because ultimately it would have to be a negative month-on-month reading, and they don't come around that often, quite frankly. So we might see some upside, but worthwhile noting that if you look at some of these sort of annualized figures that I've got at the bottom, really we're likely to see significant disinflation when we move throughout the first half of next year. But certainly I do think over the near term, we could see some bumps in the road that might hinder sentiment a little bit for the time being when it comes to headline inflation, because of course this time around the figure that's dropping out is 0%. The time after that, next month, it's a negative reading. Then the 2 months after that, it's a negative reading. So good chance we see headline inflation moving towards the upside. In terms of the core figures, like I said, 3.2 is the year-on-year figure. And again, if we're looking at the sort of comparatives, you can see 0.2 being stripped out for or 0.29 from last year. So there is a chance that we see some disinflation coming into play on the core reading. Certainly if we see a significant move on that front, for example, if we saw another 0% figure, then we could potentially see a decent move towards the downside for core inflation. And that could lift sentiment for the likes of the FTSE 100. But as we look ahead, you can see November, there's a good chance that we see inflation rise once again in terms of the core figures, and January in particular. There's a good chance we see a sharp rise once that figure is stripped out from last year. But moving forward, the first half of next year really sees the disinflation ramping up in the UK in all likeliness. In terms of the chart, let me just quickly jump on to the FTSE 100. This is not that. So first and foremost, we're going to just drop it in here to the FTSE 100. And it's worthwhile noting that the FTSE, much like many of the other indices, is sort of weakening as we go forward, although we're getting weakness within the likes of the FTSE that perhaps some of the US markets are only just starting to roll over, whereas it's sort of been rolling over since that peak that we've seen here in sort of mid-October. And of course, we're now in mid-November. So it's been about a month of downside that we've seen for the FTSE 100, heading towards this 7916 support level. But as things stand, we're seeing a very clear trend of lower highs, lower lows on this intraday basis. So as long as we don't break the 81.48 mark, there is a good chance we see further downside. And certainly if we do see a surge in terms of UK inflation, which there is a chance we do see a rebound coming into play, just given those year-on-year metrics, that could hinder sentiment once again. The caveat is, of course, core should be followed closely, because if we see core heading strongly towards the downside, that could help us a little bit on the sort of sentiment front in the UK. In terms of Canada, we have an interesting one, because if you look in here in terms of headline inflation, 1.6%, the core inflation, 1.6%, core expected to stay as it is, headline expected to move towards the upside. We've got retail sales also on Friday to be looking out for. In terms of some of the charts to be looking out for, this is the breakdown for headline inflation in Canada, 1.64. So below that 2% mark, and you can see that negative 0.43 figure from September. Really a shocker last time around. So will we see disinflation this time with October? Well, it's a relatively small number that's dropping out last time. So there's a good chance that maybe we stay put. If you look forward, February, March, April, May, much like some of these other charts for other regions, that's when we see really serious disinflation. And certainly given the fact that we already have a figure below that 2% threshold, does point towards an ability for the Bank of Canada to do what they want really when it comes to rates. You can see here, I mean, I'm using September as the comparative because of the fact that not all of these countries have released their October figures. But worthwhile noting, Canada below Japan, below Germany, the US, UK. So really in territory where they're able to flex their muscles on a monetary stance. And you can see here that we already had a lower figure a year ago as well when looking at these comparatives. In terms of the breakdown for the trajectory of interest rates, we can see here that sort of purpley, or the steep purple decline that we're seeing highlights Canada. And so the weakness in terms of both headline and core inflation has allowed the Bank of Canada to drop rates time and time again at a much faster pace than any of these other central banks. And so we're seeing them encroaching on that area where the ECB deposit rate is, despite the fact that they both topped out around about 1% from each other, 5% for the BOC and 4% for the ECB. Well, they're not that far away from each other now, because we're seeing this sharp ramp up in terms of monetary easing from the Bank of Canada. Now, if we look at expectations going forward, well, markets are looking for 100% chance of a cut in December, then another cut likely for January. Then it starts getting a little bit iffy, but still pricing in a 60% chance essentially of another cut for March. And so markets are really expecting, next 3 meetings, we're going to see a rate cut. That's not something that can be said for all of the different central banks that are out there. And that's why we want to take a look at the US dollar against the Canadian dollar. The breakout that we can see here on the monthly time frame points towards strength for the US dollar against the Canadian dollar, as these so-called inflationary policies of Donald Trump hinder expectations in terms of monetary policy. This is the daily time frame. So like I said, we broke out through this zone of resistance, so you can see from a historical standpoint, and we're pushing higher. We don't necessarily know that it's going to last forever, so to speak, but certainly until we start to break through notable swing lows on the intraday basis, then for me, I think there's a good chance we do see continued upside coming into play, especially if we were to see inflation continue to come in weak for the Canadian economy. But like I said, towards the downside, would need to start breaking down through really significant levels around your sort of 138 area to negate the current bullish trend. Until then, any near-term pullbacks are likely to be bought up by bulls. And finally, let's look at the Japanese region. There have been claims on some sides that essentially we're not necessarily in a position to be hiking rates. There's political turmoil underway, inflation weakening, stronger than expected growth. And so some of those arguments for tightening, are questionable. And certainly if we look at the week ahead, you can see 2.5% for the previous headline inflation figure, 2.4 for core. So it has been moving towards the upside. You can see also we've got those PMI figures on Friday as well. But if we see here, this is the nationwide figure. You can see from a year ago, the October number is 0.85. That's what's being stripped out. And so it's almost nailed on that we're going to see really significant disinflation this time around. So expect to see substantial weakness in terms of Japanese inflation, and what that could do in terms of the Japanese yen. Well, it would mean the potential for further weakness. We can see that the relationship between the Tokyo and the nationwide numbers does point towards further downside to come. So weakness expected for Japanese inflation. In terms of the Japanese yen, you can see dollar yen closely tracking the relationship between the Japanese 10-year yield and the US 10-year yield. I've inverted the dollar yen here. But essentially, you're seeing weakness in terms of Japanese yields compared to the US as people are sort of reining in some of those expectations around rates. And at the same time, the Federal Reserve people are easing off on the idea that we're going to see too much in terms of rate cuts from the Federal Reserve. Of course, these data releases have the opportunity to shift that narrative. So if we were to see strong inflation data coming out, then that's one thing. But we're not expecting that because, as you can see here, the year-on-year shows that October 0.85 figure being stripped out. That means the potential for significant disinflation from Japan. It sets us up for a potential period of further weakness for the US dollar and strength for dollar yen. And so when we're looking at, say, dollar yen, you're talking about the possibility of further strength. However, we're coming into this area where you're already talking about when we see intervention from the BOJ once again. Sorry, this is dollar CAD. So this is where we're talking about, will we see intervention once again? 155, 160s. Those are the areas where we've seen the BOJ step in. Will they do so once again? Certainly coming off the back of this protracted period of weakness, we're now seeing the inverse. We're seeing much of that regained as people grow less confident over the idea that the Federal Reserve are going to be cutting rates in a radical manner. So as we move towards the downside, I think there's a good chance that bulls will step in once again unless we see a breakdown through significant support that we have here at 152. So near-term downside, you're going to be looking out for this ascending trend line as a potential area. But if we're going to see substantial weakness in terms of Japanese inflation, it really continues the dollar yen strengthening story that has been playing out of late, and strengthens the idea that perhaps the BOJ are going to feel like they don't necessarily have to do all that much to be able to drive down inflation if we're already seeing significant disinflation coming into play. So that's it for today. I hope this has been useful. Another interesting week ahead for financial markets. It's also worthwhile noting that from a corporate perspective, we're going to be seeing numbers from NVIDIA as we try to wrap up the third quarter earnings season. Thanks a lot, guys. Join us next time here at Scope Markets. My name is Josh Mahony, Chief Market Analyst. Thanks a lot.